Dave Ramsey has often painted a bleak picture about reverse mortgages, but is his stance backed by facts? I don't believe so, but today we're going to discuss how Dave Ramsey feels about reverse mortgages and counter that with what is actually the rules in 2023, and how I believe he's not correct. Stick around to the end of this video so you can get a better understanding about how I believe a reverse mortgage is a fantastic option for senior homeowners. All right, let's get into it. Dave Ramsey has several videos out there on YouTube debunking reverse mortgages, but I picked his very first one, done 6 years ago. His first video 6 years ago, he opens it up with this case study, this Washington Post article. Now, this Washington Post article from 2017 is one of the most widely cited reasons against reverse mortgages here on YouTube and out there on the internet. It talks about Virginia Rayford, a 92-year-old woman, going through foreclosure on reverse mortgages. And when you take a look at this article here, and basically, the mainstream media is all about spinning a narrative. And sure enough, here you go. Here's a little old lady on her porch, and with a cracked roof. I mean, it's meant to generate an emotional response. I mean, the mainstream media is in business to generate clicks, okay? So, and this is what they're doing here. So everyone sees in this article when they look at it. And a lot of what Dave Ramsey believes, what he mentioned in this first video 6 years ago, this is kind of where he got that information from. And he's really been kind of parroting that, in on subsequent videos as well. And in the article he cites how Virginia Rayford is citing foreclosure, due to unpaid tax and insurance, and how the balance has grown.
As she was getting on in years, her resources dwindled. Virginia Rayford took out a special kind of mortgage in 2008 that she hoped would help her stay in her 3-bedroom Washington row house for the rest of her life.
Basically, he cites the risk of default. And the way that he frames it, it's almost like they're the only ones who pay tax and insurance. And his major crux of his argument is that it's a risky loan because they may not pay tax and insurance. Well, that's not in and of itself like getting a reverse mortgage. I mean, if you're just a homeowner with a regular mortgage, try and not pay your tax and insurance to see what happens to you. They're going to foreclose. So it's not endemic to the reverse mortgage. So, generally on a reverse mortgage, one of the requirements is you must maintain property expenses, your tax and insurance on your property. Now, I understand how some folks over the years might have been used to an escrow account paying that, and I'm very clear on when I talk to my borrowers, like, you have to pay these things directly. You can get on payment plans with your local county assessor or your insurance company to kind of help you become automatically, you have an automatic withdrawal on that. For those that don't know me, my name is Emmett Dempsey. I'm a mortgage broker here in Florida. I'm licensed in Florida, Georgia, and reverse mortgages are a focus of my practice. I believe that they are a fantastic option for seniors, and they need to know about the ins and outs and whether it's right for them versus all the gurus and misinformation online. If you're in the market for a reverse mortgage, if you go ahead and click the link in my bio, you can kind of sign up to receive a free reverse mortgage guide. Kind of has all the different ins and outs and frequently asked questions if you're in the market for a reverse mortgage. And of course, if you're in the market for a reverse mortgage here in Florida and Georgia, I would love to help you out, kind of answer any questions you may have. All my contact information is in the bio. If you would, just go ahead and leave a like in this video. It helps other folks know that this video is good information for others to find, and it really helps out YouTube algorithm. And again, if you haven't already, please subscribe to the channel. And if you would, go ahead and leave a comment. What do you think about Dave Ramsey's advice about reverse mortgages? Am I wrong or am I right? And another thing that Dave cites is a default rate of 14%. This original video was done in 2017. So he's using stats from loans done in the late 2000s, early 2010s. And what happened was in 2013, 2014, HUD began to use a financial assessment. Okay, and financial assessment ensured that seniors had to be able to pay this tax and insurance. And since that's happened, financial assessment is working. So that's one of the fixes that was done. Identified a problem and implemented a fix, and then that's what's happened. So in Dave's video, he's like saying, well, normal mortgage is about 3%. So it's in line with what he's saying it should be. That's point number one, debunked. The next thing that Dave cites is high loan terms and high rates and high costs. Now, I'm going to say he's mildly right on that point, but not for the reasons why he's saying. First of all, let's address the interest rate. Now, a reverse mortgage is a zero recourse loan. So these loans grow over the years, and they can never go upside down, and the families can always sell the property at 95% of value. So yes, the interest rates are generally higher than you would on a normal fixed rate, but really in this interest rate market in September 2023, it's not that much different. In fact, the ones I just closed last month, they're about the same as the normal fixed rates, the way they've been going. So his comments were made 7 years ago, or so 6 years ago. Rates are much lower than they are today. So so there was probably a spread for that. But as of 2023, the interest rates are just a little bit higher than market. But again, it's a non-recourse loan. So that's number one as far as the interest rate. As far as the costs go, what he's citing, and this I explain to my clients, the costs are higher because of the way that the mortgage fees are calculated. Now, if you're to do a normal refinance or purchase, as for instance, around here in Florida, we have title insurance and doc stamp. So your doc stamps are based off of a percentage of the loan amount. It's 0.2% of, for intangible tax and 0.35% for doc stamps. And then so that's what those fees are calculated off of the starting loan balance, right? But on a reverse mortgage, that balance is going to grow. So of course the government rules, the way they're written, they want it based off of 1.5 times the appraised value of the maximum claim amount. So yes, it's a much larger number. So is the fees bigger because I just want to charge seniors more in fees? No, that's the government saying, hey, I want to get they want to get their money, and they're charging the reverse mortgage because they saw how the balance grows, and they don't do it off the small balance when it starts. They're like, no, we're going to do it off of the maximum claim amount, which is the appraised value. That's just endemic to the way fees are calculated here in the state of Florida or in any other state. So, and usually title insurance, which is mandatory on any mortgage, again, that's all scalable to a loan amount. Florida has a promulgated rate based off of, again, the loan amount. For reverse mortgages, it's based off the maximum claim amount. So again, it's bigger than a side-by-side refinance. So yes, is he right? Yes, but not for the reasons why he's saying. It's not just an arbitrary fee. So basically, all of Dave's points that he made are basically have been fixed with either financial assessment, and again, not paying tax and insurance is not a reason why that defaults are higher. Okay, so what are some of the reasons why reverse mortgages, as they have in 2023, why they're a better option? Number one is that financial assessment. So we're going to make sure that before you go into a reverse mortgage, that you're able to pay tax and insurance, throughout the life of the loan. If not, there's something called a LISA, or a loan expectancy set aside, where they set aside a portion of those proceeds and they pay it for you. Most of the time, my clients don't need a LISA. They're able to pay those tax and insurance payments on their own, or they have their family members do it. But they account for it, and they make sure that you have sources of income in order to qualify for it. Because before 2013, it was purely asset-based. There was no income occupation at all. It was like, oh, you got equity, here you go, here's a reverse, and you can take out a lot more than you can now. I know in I think it was 2021, they reduced the amount to, I believe, 60% of the maximum claim amount that you can take out. So again, they're putting restrictions, they're analyzing the data, and they're and they're taking action. Now you have to understand, the HUD program, the HECM program, was only started in the 80s. Most mortgages are much older. They started around the Great Depression, so they have decades more of iterations in respect to the reverse mortgage, which has been around only since the 80s. To their credit, they've really stepped up and they've made those changes. Another major change that they made is spousal protections. Before, you'd have a senior who is much older, might have a much younger spouse. That older person would die, and then the spouse would be disenfranchised, have to move or sell right away. Well, they've made some changes to non-borrowing spouses. Say, hey, we had a problem, and we fixed it. So that's kind of what they made those protections for non-borrowing spouses as well. Also, what Dave mentions in that article about how they owe so much more and they're out of equity. Well, I know in most areas of the country, appreciation outpaces the growth of the reverse mortgage. The best documents that I provide in the reverse mortgage counseling is an amortization table. It kind of looks at the next 20 plus years. And we use a conservative appreciation about 4%, which nationwide they've been much more than that. So you can kind of see over the years where you'll be, so you'll always be able to have equity. And again, as I mentioned several times on this channel, I put my own mother into a reverse mortgage. And when she died, I was on both sides of the table. So I know when she died, she was able to leave money to me and my five brothers and sisters. So there's enough out there. I believe in a reverse mortgage because it has several benefits. For instance, it has no monthly mortgage insurance payments. You can definitely increase your cash flow. Several of the refinances that I've done had paid off their traditional first mortgage, gotten them cash out, as well as a growing credit line that can use for liquidity. Liquidity in retirement is definitely a huge option. I've seen certain articles that over 60% of the wealth of a senior citizen is in their home equity. So what are they going to do? They're just kind of let it sit there and grow and maybe pass it on, rather than improve their quality of life and increase their liquidity today, so they can do the things they want to do, either fix up, go on a trip. It allows them peace of mind and liquidity and just quality of life. And that's what I did for my mother. She's able to live in her house visit with their grandchildren and not have to worry about a mortgage payment. And that's what I believe reverse mortgage can do. Yeah, I mean, Dave Ramsey has been an amazing help to many families. His advice has helped, I'm sure millions of people get out of debt and to put their own family on good financial footing. And nothing against Dave Ramsey. I think his advice is amazing. My wife and I have been at Financial Peace University, and I believe in a lot of what he says, and we try to implement it into our lives. But I believe he's dead wrong about reverse mortgages. And I think his advice is listened to by a lot of people, and they're turned off getting a reverse mortgage, or at least learning more about it because of what he says. And I think reverse mortgages are a great addition to alternative financing, because what I found, and I cited this in my other video, that I talked to many seniors with amazing credit scores, paid off mortgages their whole lives, and the alternative is to get a traditional HELOC, which can be closed. A lot of times they can't qualify it because their income drops. So reverse mortgages can be a fantastic alternative to other financing by eliminating your mortgage payment, increasing a credit line that grows with LIBOR. At this point in the video, you might be wondering about other reverse mortgage videos we have on the channel. So YouTube wants you to watch this video right here.